Welcome to the Money Over 50 podcast, brought to you by Michael Hogue and Ali Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Michael and Ali Hogue.
Welcome to the Money Over 50 podcast with myself, Ali, and Michael. Now, Michael, we've got an interesting topic that you are very passionate about. I've seen him discuss this in meetings, and you'll probably hear it in this podcast. What do you got for us?
I've called it your $3.8 million tax-free trust, which is a very unique title, I suppose. It's marketable.
Yeah, I don't think there's anyone here in Australia that wants to pay more tax than they have to.
I'll walk everyone through, and look, please bear in mind, occasionally we get emails through to the podcast channel saying your example didn't suit me at all because I don't have anywhere near that amount of money. So you can do this with any sum of money. I like to use the maximum. Yeah. Because I want people to know what the maximum is. So don't get offended. Please try not to get offended. I'm just using this as an example. It's per couple in this example. It's applicable for single people as well. So walk through it. So basically, a 0% taxed superannuation income stream is like having a tax-free trust fund. So 0% tax is levied on the rate of return internally, and 0% tax is levied on any income drawn out of the fund by the recipient, assuming that they're aged over 60 or over. So the example that I'm going to use, the examples that we're going to use today are for people. We assume that they're aged 60 and over. Yep. Because there are other ways to qualify for this earlier, such as being classed as totally and permanently disabled. Yeah. But the general conditions of release are for people that are aged 60 or over. So what is a 0% tax superannuation income stream? Well, it's a superannuation fund that has been converted into a 0% taxed fund. So for reference, a normal superannuation fund in accumulation phase, which most of us have, before we start drawing an income from that, is taxed at 15% on the rate of return or the earnings internally. So you lose some of that rate of return. What I'm talking about here is that when you qualify and when you meet a condition of release, most people think of that as being able to access their superannuation. Look, we think of that as the hidden benefit of people being able to keep their money in superannuation. Yeah. But convert it into a 0% taxed version of superannuation. Now, the confusing part here is that this is known as a multitude of things. One of them, it's technically called a superannuation income stream. Yep. It's a type of superannuation income stream, is known as an account-based pension. That's what we're referring to here. Yes. It's also referred to as an allocated pension. It's referred to colloquially as just a pension. So I just want to be clear. Yep. This is completely different to the pension or age pension that we get from Centrelink? Yep. Completely different? Completely different. And I don't like the word pension because of the fact that people do get it confused. So I'm going to call it a superannuation income stream. Yep. The market. What's even more confusing is that the marketing name of the particular superannuation fund that you're in may call it something completely different, such as Australian Super call it Choice Income, our account-based pension. Yeah. So look, it's really confusing for the consumer. Really confusing. It's a topic that, again, not a lot of people don't really know much about superannuation, and when you're giving different terms for the same thing, I can understand why people don't understand. It's so confusing. I can understand that. So I guess think of this as having the money that you accumulate in superannuation when you meet this condition of release. Again, most people think of that as I can access my superannuation. Do I cash out all my superannuation at that point in time? We actually think of this as an opportunity to hold your money still in the superannuation environment, but move it into the 0% taxed superannuation income stream environment. How it works is that there are limits that you can open one of these accounts with. So you can have more money in superannuation, but the current 2023-24 limit is $1.9 million.
Yep.
Per individual. So there's where the $3.8 million title comes from.
Now,
it's assuming a couple, the maximum that a couple could open in 2023-24, maximum that a couple could open would be $3.8 million combined. They are individual accounts. So I'm in my example, I'll talk about figures together.
Yes.
But they're actually individual accounts or member balances that you have.
Yep.
That particular piece of legislation is known as the pension transfer balance limit. So it does get indexed up. So to give you an example, that started out as $1.6 million. So I forget what financial year that was, but people that were doing this at that point in time, individuals that were doing this, were only able to open that with a $1.6 million balance at that point in time. It's now currently been indexed to $1.9 million.
Now, and just to butt in there, just keep in mind though, that's how much money you can get in there, but returns and things, your balance can increase above that, of course, depending on the return that's in there. But getting the money in there, that's where your limit sits.
Yeah, spot on. It's a good point to make. So I had a client that started out with $1.7 million when the cap had been indexed up to that. And he currently has over $2 million. So his balance has grown, and that's fine. He doesn't have to take out $300,000. It's just it's measured right at the start in that particular year. So let's go through and use an example here. So let's say I will use $1 million example as well. So let's say there's an individual and they've built up $1 million in their superannuation fund. Now, remember that internally, even though they can't access this money before they meet a conditional release, it's making a rate of return, and that rate of return is being taxed at 15% internally. They meet a condition of release. Now, the main conditions of release, there's more than this, but I'm just going to talk about the main ones today. So the first one, attaining the age of 60 and then ending an employment arrangement. So what that means is that I could still be in the workforce. It's just that I've turned 60 and then I've finished with one employer and I'm starting on Friday, for example, and I'm starting with another employer on Monday.
It's
well, I've met a conditional release.
Yeah, another example on that. Sorry, I've just had a meeting with a potential client, and she has 2 roles.
Yep.
And one of her things is she wants to potentially semi-retire or drop at least one of the roles around that 60 years old. And that's a good example of where you go, if you do that at age 60, just drop one of those roles. Essentially, you meet that condition of release because you've ceased an employment arrangement. Is that correct?
Correct. Yeah, so it doesn't have to be your full-time job. Legislation is fairly broad, so it's fairly grey, and it says you've had to have attained the age of 60 first and then ended an employment arrangement after that, and that's a condition of release.
Yeah.
I've never tested it, but like technically the way the legislation reads is you could potentially, and don't take this as advice, because I've never tested it with the ATO, but you could hold your full-time job. You could take on a part-time shift at McDonald's or Bunnings, and then turn 60, resign from that part-time shift, keep your full-time job. Like, you've technically ended an employment arrangement. I digress.
Yeah.
But that's the way the legislation reads. So the first way is to attain the age of 60, end an employment arrangement after that. You do not have to fully retire. Look, this is perfect for people that want to move to part-time work. Second main one attaining the age of 65, even if you haven't ended an employment arrangement. So you could continue your full-time job, turn 65, have no intention to retire for another year or two or even beyond. You've met a condition of release. Now, one of the big advantages of that is that you don't have to cash out your superannuation at that point in time. You can move your superannuation into the 0% taxed superannuation income stream.
So I'm guessing this is the main benefit that you're talking about, where a lot of people would probably think that you'd only look to move it in that 0% tax-free trust, as you call it.
Yep.
When you need to draw an income, but there's other benefits of potentially moving it over before that anyway.
Correct. So we'll get to those examples, but first of all, let's assume, just for simplicity's sake, that an individual has gotten to 60, they've ended an employment arrangement, they have $1 million superannuation account balance, and that generates an assumed rate of return for these purposes of 8% per year. Well, that 8% per year at the moment is being taxed. It's being taxed at 15%. What would happen is if they moved that fund into a 0% tax superannuation income stream, is that it would, assuming the same investment strategy, return the same 8%.
Yep.
It's just that no tax would be levied. So $80,000, the fund would actually then make $80,000 a year. No tax is levied. They could then, in this simple example, if they drew $80,000 out as an income, their fund balance would stay at $1 million. They wouldn't go backwards, they wouldn't go forwards, and they could draw $80,000 income. Now, that income is also tax-free. Now, here's the difference. Assuming that person had been previously employed on the same $80,000 a year, while they were working and earning employment income, the current tax scales in 23-24 are that $80,000 of employment income that's fully taxable.
Yep.
That person would lose $18,067 in income tax for that year, which would leave them with $61,933 in the hand.
Oh, it's a huge difference.
It's a huge difference. So in this case, they've actually stopped themselves working, and instead they've got their money working for them.
Yep.
And effectively, it's a really simple example, but they've said, okay, there's a line in the sand here. I'm going to work up until that point. I earn $80,000 a year, but I'm taxed at $18,067. From that point on, I'm going to let my money do the working, and it's going to generate an $80,000 return for me. I'm going to draw that out as income.
Yeah.
Well, hey, I pay $0 in tax. This person pays $0 in tax after that. And here's where I'll use the larger example. So a couple earning employment income or other generally taxable income in 2023-24, and assuming that they earn $304,000 per year as employment income, and that's split right down the middle. So half is earned by one member of the couple and another half's earned by the other member of the couple. They pay a total of $88,694 in combined income tax to leave them with only $215,306 in the hand from that $304,000. Now, assuming that they were able to use their full pension transfer balance limits of $1.9 million each and started retired life out or semi-retired life out with a combined amount of $3.8 million in the 0% taxed superannuation income stream, a la the tax-free trust, that earns an assumed rate of return of 8%. That's $304,000 per year. There's $0 in tax levied on that. And not only that, again, using that same example, if they didn't want to grow their balance, they didn't want it to decline, if they pulled that $304,000 out as income, they would pay no tax then. So, look, when I look at this, I would sum up, and this is just my opinion, I would sum up Australia as one of the highest income tax rates in the Western world. Yeah. So we're higher than America in income tax. We're higher than the UK in income tax by my calculations. We are one of the most generous in retirement. So because in both of those and both of those countries, most of their pension funds that they have over there or have some level of tax levied on it.
Yeah, that's correct.
In this situation, though, look, a couple, the maximum amount they can get in is $3.8 million into a 0% tax superannuation income stream together. Again, the legislation to look up is the pension transfer balance limit. It's currently $1.9 million per individual.
Yep.
Look, really, without giving advice, and I want to stipulate the general advice warning here, look, this is the mecca for people's retirement.
Yeah.
So you'd be hard-pressed to say that this holding environment for people, for their retirement assets, wasn't the best type of holding environment for them because of the fact of that 0% tax on the internal rate of return.
I've seen that a lot.
0% tax on the way that they...
particularly, I've seen that a lot with self-employed clients and, have a significant amount of investments outside. And when you, like you just explained and with those examples, that tax difference on those earnings is huge.
Yeah.
And particularly if you want to try and get as much money in there as possible. Now, of course, that takes prior planning because you can't just get 3.8 million in one go. It takes years of planning. But like you said, the whole idea is you want to try and get as much as you can into there up to that cap because 0% tax is amazing. And I don't think there's anywhere else you can get that.
Look, it doesn't, there's no such thing as negative tax in this scenario. So 0% is the best it gets. And it's a really, really hard thing to achieve. And you can see the tax savings that the comparison of when you actually have to go to work and earn that income the year before and then the year after you qualify, you meet a conditional release, assuming you've got enough capital in there to generate that same amount of income, it's just so much more tax effective.
Yeah.
Now, you may be sitting here thinking, where do I find these? Look, this looks and smells like a normal superannuation fund.
Yeah.
So, look, most big superannuation fund providers offer a 0% taxed superannuation income stream product that they will call an account-based pension, or they call it an income account, or they call it choice income or something like that,
I'd say
which is where it gets confused.
Keywords there would definitely be pension or income, usually.
And reading the fine print, it will usually say, it won't be usual. It will always say this is an account-based pension, usually. There's a multitude of investment options available. So it's actually investment strategy agnostic. So, if you're more tilted to having more conservative investments, then most superannuation funds that offer this, just as they do with their standard superannuation accumulation funds, they will offer a range of investment strategies as well.
Yeah, that's correct.
So it's not that this is the rate. So the rate of return of 8% that I use is just a generic example here. That rate of return could be north or south of that, and expect volatility, of course. Yeah. But because it all depends, the rate of return all depends on what the actual product is and what the actual investment strategy of that product is as well. It's one of those things that, I guess, what else am I thinking here? Significant strategies, as you touched on before, Ali, because look, just through contributions, just through salary sacrifice or other concessional contributions and your employer contributions, it's a fair assumption to say that people that are age 60 now don't have, the average person doesn't have $1.9 million in superannuation. Look, there's strategies to get outside assets into superannuation and then into a 0% taxed superannuation income stream from that. Yeah. So, look, it is popular, and certainly popular. I shouldn't say popular. It's appropriate for many people, including our clients. This is where I think we do the best work for our clients as they lead up to retirement. We're actually looking at getting other bits and pieces of assets in. So, it's common for people to come to us with significant cash savings. It's common for people to come to us as clients with investment assets. It's common for people to come to us with rental properties and investment properties and things like Look. When we go through it with most of our clients, it makes sense for us to actually try and get those assets into superannuation to top up their balances.
That's correct.
With the strategy of actually, pulling that lever and turning that into a 0% taxed fund. You have to be careful, and this is again where I need to remind people this is a very complex strategy. So I'm trying to explain as much as I can and use examples. However, not all of these examples will suit every listener here.
Yeah.
Here's the lawyer's warning. It's a general advice discussion. So the examples used may not suit your individual needs. You need to consider the risks and whether it's suitable for your own particular needs. Now, there are some things to be wary of. A big one is capital gains tax. So we just talked about some of our clients selling rental properties and things like that. Well, you need to be aware that if you were to do that, that's assessable for capital gains tax generally.
Yeah.
And that can significantly, impact, make a difference in terms of...
A good example of CGT and when that wouldn't be suitable. Let's say we've got someone who's right at the top of, say, earning 180 or 200 grand a year. They've basically maxed out all their concessionals.
Yep.
And they decide they've got the option to sell an investment property now or a couple of years down the track when they're retired. If they were to sell it now, essentially we wouldn't have any chance to, one, reduce their taxable income because we can't make any concessionals. And then because they've already reached the top marginal tax bracket, they're going to pay top dollar on tax on that. So this strategy just wouldn't work for them at that situation. There'd be other ways to look at that and manage that, but it's something to be aware of on what you're touching on there.
Great point, Ali. This doesn't have to be something that's all done right at the cusp of retirement. So what I mean by that is that in this, let's flow this example through again. So a couple has aspirations of actually fully funding their $1.9 million pension transfer balance limit each. They have $1 million in superannuation each, and they have all these other assets that have capital gains elements to them. And they're on a high marginal rate of tax right now as they're working. So they can actually retire first. Start to draw an income from this. Now, one of the other big advantages of the income drawn from a superannuation income stream, I mentioned before that it's tax-free. Even better, as long as you're over 60, it doesn't actually show up on your tax return whatsoever. So it doesn't even push other income up into higher tax brackets. These people could retire at, say, 65, just to pick a figure. They have up until age 75 where they can actually get money into superannuation, including $110,000 of full non-concessional contributions cap each per year. They can use the non-concessional contributions cap bring forwards, which means they could get more, 3 years of that $110,000 in one particular financial year. And they can do that up until, I'll say 75. The actual legislation is something like 30 days after the month end.
Which I've done for a particular client. I think it was like 2 days before. And this has to go in now or we can't. But if you do want to look further into that particular topic, we've got an episode 314, which goes all over those age limits there and discusses that.
Yeah, brilliant. So it's not a fact that you have to use it all at the start. So following that example through, they use $1 million of their $1.9 million pension transfer balance each.
Yep.
Well, the following year after they have retired and their taxable income is reduced down to effectively zero because they're drawing their income tax-free from their superannuation income stream. They could choose to sell one rental property then and manage the capital gains. Push that. They could push that money into superannuation and then into their 0% tax superannuation income stream. There's a particular way you need to do that. I won't go into that here. Let's say another $200,000 goes in each. Well, then they've used $1.2 million of their $1.9 million pension transfer balance cap. They could pull the trigger again the following year, add another $200,000 each.
Continue.
Obviously subject to non-concessional contribution, bring forward limits and all that sort of stuff. But look, there's and they can also, with capital gains, then they can also then tap into any concessional contributions as well.
That's right. That's exactly right. So you can get a bit more.
So look at like I said, this is where I think we definitely do our best work in actually moving people, transitioning people from full-time work to part-time work to a confident, self-funded 0% tax retirement. Like our objective for it, we start with this objective for everyone, is that the day that one of our clients retires is the day that is the last day that they've paid $1 of tax ever again, and more importantly, it's got to be legal.
Yeah. So no business structures in Malta or China.
Look, this is all perfectly legal if you get it right, and there's a specific order to get things correct. We are experts on that. A couple other things just to be wary of. There are government-mandated income limits. So if you're under 65, you need to draw 4% of the 1st of July account balance each year. So you need to draw a minimum. If you've got $1 million in there, you need to draw a minimum, not a maximum, a minimum of 4%. So that'd be $40,000 per $1 million. When you get up to 65 to age 74, it goes up to 5%. Look, that does increase over time. Between 90 and 94, ages 90 and 94, it goes up to 11%. Now, you need to draw that income. You don't need to spend it. So there's people that, as their income goes up, they need to draw it out. But what they can do is either park that in a bank account, they can gift it away, they can do a multitude of things. Like it's all tax-free. They can set up an investment that replicates what they have. The other thing to be wary about is that it can run out of money as well. But so can a bank account. So if you take more than it makes and you do it for long enough, it'll run out. So what I mean by that is that the rate of return is very important. If you're taking, if you're only generating a 4% rate of return, but you're taking 8% of the account balance every year, then it's going to run out. But like I said, so does a bank account. As you spend more money. So just one of those things to realise. But really, look, I consider this the mecca for retirement for Australians. A 0% taxed retirement. It's very, very tax friendly. There's ways that you can qualify from age 60. You can move to part-time work, which even makes that part-time work even more tax effective.
That's good.
You can draw part of your income from your 0% tax superannuation income stream and draw part of it from your part-time wage. You can even continue to push money in, so you can push some of that money back around, into superannuation. And then
which is something we do a lot. Hey, so a lot of my clients, when they get to that stage, they're already semi-retired. They're earning about what they need. And basically any of that income we're drawing out from the pension account, we're just using to make contributions and again use up their concessional cap space and get that tax saving as well. So they're just cycling their money around, and it's fantastic. It's a funny one, the government mandated income. So I get this question asked a lot from new clients, and they always ask why. Why do we have to take money out of it? And at the end of the day, I don't think the government wants your money to be sitting in an investment structure where there's no tax being paid to them. That's how good it is. They're forcing you to take some money out of it because you just can't keep it there.
Look, that's I mean, no one really knows because the government is a collection of individuals.
That's exactly.
Who knows? But the general gist of it is that they don't want someone going in with $1.9 million and that growing to $19 million because they don't need to take any income out. You know what I mean?
Correct.
Which it could. The other things to look at just off the top of my head as well. Look, there's significant estate planning advice that you would need around this as well. I won't go into how all that works, but there's things to be wary of. Between a recognised spouse, their 0% taxed income streams can be passed tax-free completely to each other. What where the issue becomes is that down the track, if the remaining member of a couple or a single person passes away with their money still in this 0% taxed fund, they're assuming that that money is being passed to adult children beneficiaries or non-tax dependent beneficiaries, which that would generally be, considering the people's that hold this money's age. There is some funds that would be potentially taxed at that point in time. We have looked at that in podcasts before. It's something to be wary of. There's no way around that. Well, there is a way around that. I guess the alternative is that someone would say, "Oh, look, I don't want my adult children to pay any tax at all. I'll cash all my money out and I'll invest it." And what would generally happen is they'd pay so much more income tax throughout their life in drawing taxable income from that.
We've got the
and their children would still pay capital gains tax as well. So there is a podcast.
Episode 39 goes all into the nitty-gritty of trying to avoid that potential 17%, up to 17% inheritance tax. So
yeah,
it's there. Number 39. Now bear in mind the quality might not be as good as it is today, but it's got all the information you need there.
That's all I had.
Excellent. Well, thank you for listening. Talk soon. Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. For more information and resources, visit the Money Over 50 website, mo50.com.au. We look forward to catching up again soon.